Hey guys, hope you are all well today. Months ago, we talked about the beginning of a dangerous thread with the rising number of credit card defaults in America. Almost a year later, things have not improved. Inflation may be going down, but Americans report living paycheck to paycheck, barely able to make it through, and now we have the Federal Reserve Bank of St. Louis warning of a recent rise in credit card debt delinquencies. The dangers of more Americans defaulting on their debt cannot be overstated. It could significantly hamper the ability for the economy to fully recover, but more on that later. Before we start, let me quickly shout out my Discord. If you are looking for a great trading community with a high success rate, come check us out. We have the most dynamic and profitable day trading community on the internet. If you're interested in building wealth and mastering the art of day trading, you're in the right place. Our Discord is home to a team of experienced and successful day traders who are ready to share their knowledge with you. With years of combined experience, our experts will guide you through the ups and downs of the market, helping you make informed decisions. A ton of content is open free for everyone to participate, and the Discord is free to join. The link will be down in the description. Let's begin. A new report by the Federal Reserve Bank of St. Louis highlighted a lot of the growing concern in the financial system. Americans frequently rely on credit cards for borrowing money. In 2022, a staggering 82% of U.S. adults possessed credit cards, with nearly half, or 48%, carrying balances. When borrowers fail to meet their payment obligations on these outstanding balances, their accounts slip into delinquency. This unfortunate scenario triggers interest charges, fees, and penalties that can adversely affect the borrower's credit score. In severe cases of delinquency, individuals risk having their accounts closed and losing access to credit altogether. Historically, credit card delinquency rates soared to unprecedented levels during the global financial crisis. Several factors contribute to an uptick in credit card delinquencies during economic downturns. One primary reason is the increase in job loss, a direct consequence of recessions. During these tough times, individuals may find it challenging to keep up with their credit card payments due to reduced or eliminated income. Additionally, during economic downturns when credit conditions tighten, banks often withdraw enticing promotional offers, such as 0% APR balance transfers. This eliminates borrowers' ability to transfer and manage their unpaid debt more affordably. However, thanks to various forbearance programs, restrained spending patterns during lockdowns, and generous government benefits, households managed to maintain historically low delinquency rates during the 2020 recession and its immediate aftermath. Nevertheless, towards the end of 2021, credit card delinquencies began to show signs of growth. I want to delve into a comparative analysis, examining the recent surge in credit card delinquency rates and contrasting it with the increase experienced during the global financial crisis. We define credit card delinquency as an account that is 60 days or more past due, excluding severe derogatory debt exceeding 120 days past due. Now, let's dive into the data. The figure below reveals the percentage of people among all U.S. adults, irrespective of whether they're credit card holders, who are late on payments, categorized by age group. To ensure accuracy, we exclude individuals younger than 20 or older than 79. In the figure, the left panel encompasses individuals from every zip code across the U.S., while the right panel isolates those residing in the country's most financially distressed zip codes, constituting 20% of all households. We emphasize this group of zip codes because past research has shown that they are disproportionately affected by weak economic conditions, experiencing more substantial declines in consumption compared to the general population. The data paints a clear picture of age correlating with delinquency. The blue lines in each panel represent delinquency rates for individuals aged 20 to 39 in both the aggregate group of zip codes and the most financially distressed group, right panel. Notably, this youngest cohort tends to have a higher fraction of individuals experiencing delinquency than their older counterparts aged 40 to 59 and 60 to 79, represented by orange and gray lines, respectively. The reasons for this could range from higher unemployment rates to more restricted access to credit due to shorter credit histories, among other factors. Across all age categories, the most financially distressed group of zip codes consistently exhibits a larger percentage of people suffering from delinquency compared to the entire sample. This persistence underscores the enduring financial distress, as the selection of the most financially distressed zip codes was based on delinquencies in 2018, not delinquencies spanning all years. Now, let's focus on the dotted lines, representing the average proportion of adults aged 20-39 late on credit card payments during the global financial crisis. Fast forward to 2023, delinquency rates have increased significantly across all age categories since 2021. However, as of the second quarter of 2023, delinquency for all three age cohorts was slightly below the average levels seen during the global financial crisis, as indicated by the dotted lines. The delinquency rates for the two youngest cohorts in the most financially distressed zip codes, right panel, recently reached their global financial crisis averages. The middle cohort, ages 40 to 59, surpassed its global financial crisis average by a marginal 0.1 percentage point in the second quarter of 2023. Meanwhile, the youngest cohort, ages 20 to 39, exceeded its global financial crisis average in the third quarter of 2022 but has since declined over the last two quarters. These statistics suggest that households younger than age 60 in the most financially distressed zip codes find themselves in situations comparable to those during the global financial crisis. The data tells a story of financial challenges that persist and evolve over time, impacting different age groups and communities. To gain a more comprehensive understanding of debt in the U.S., it's essential to explore the extent of delinquent debt. This analysis takes a different perspective by examining delinquent credit card debt as a percentage of all credit card debt. The Fed has seen that the percentage of delinquent credit card debt organized by age cohorts for both the entire group of zip codes and the most financially distressed zip codes. The dotted lines running horizontally represent the average percentage of delinquent debt during the global financial crisis for each age cohort. Once again, the blue line, similar to the previous figure, the most financially distressed group of zip codes exhibits higher rates of delinquent debt across age categories compared to the aggregate group of zip codes. However, in contrast to the earlier figure, none of the cohorts in either group of zip codes approaches the levels of delinquent debt recorded during the global financial crisis. As of the second quarter of 2023, the percentage of delinquent debt for all cohorts was significantly lower than their global financial crisis averages. The key takeaway from this second figure is that the proportions of unpaid credit card debt, while seeing some increase, remain relatively low. This is especially evident for the youngest and middle cohorts, with levels reverting to those observed in the years preceding the pandemic of 2020. In contrast, the oldest age group does not show a similar trend. I've been following this subject very closely in 2023, and things have gotten worse. Inflation is taking a toll on Americans, pushing credit card and auto loan defaults to levels not seen since the financial crisis. The struggle to pay bills is expected to intensify with rising interest rates and the impending expiration of the student loan moratorium. Low and middle income earners are bearing the brunt of surging prices across essential expenses like rent, groceries, and vehicles, despite the Federal Reserve's efforts to control stubbornly high inflation. This year, credit card delinquencies have reached 3.8%. While 3.6% of individuals have defaulted on their car loans, according to Equifax, marking the highest figures in over a decade. Moody's Analytics chief economist, Mark Zondi, said, and I quote, "The increase in delinquencies and defaults is symptomatic of the tough decisions that these households are having to make right now, whether to pay their credit card bills, their rent, or buy groceries." Many low-income consumers are resorting to credit cards for purchasing groceries and essentials as their savings from pandemic-era government stimulus checks have dwindled. Amidst record-high average interest rates at 20.6%, according to Bankrate.com, borrowers are opening new lines of credit to manage their debts. The number of credit card accounts has surged by 70 million since the pandemic began in 2019, and credit card debt has exceeded $1 trillion for the first time ever this year, according to the New York Federal Reserve. And I am not the only one that's scared about this trend. Economists are also expressing concern, with Mike Brisson, a senior economist at Moody's Analytics, describing the growing delinquencies as very concerning. The possibility of further interest rate hikes by the Fed to curb inflation could compound the burden on credit card holders. Additionally, student loan payments, paused for several years, will resume in October, affecting individuals already struggling with high costs of living. While the pain felt by consumers may align with the Fed's objective of achieving a soft landing and preventing a recession, it also raises concerns about consumers accumulating more debt during the holiday season. Rising energy bills as winter approaches could further strain their finances. The elevated prices of vehicles in recent years have also contributed to the financial squeeze on vulnerable consumers. Retailers like Macy's, Kohl's, and Nordstrom have reported rising delinquency rates among customers with private label store cards, signaling challenges in the retail sector. Macy's, for instance, acknowledged that its store card delinquency rates were rising faster than planned. Retailers like Foot Locker have attributed disappointing financial results to consumer softness. Going back to Moody's Analytics, Business Insider reported that they cautioned that defaults and delinquencies among young adults, who have accumulated credit card debt, could surge due to tightening financial conditions impacting consumer spending in the United States. A recent note from Moody's, published on June of this year 2023, highlighted the impact of higher interest rates, which have increased borrowing costs and slowed down consumer credit usage. Outstanding balances across all consumer credit products grew by a mere 0.2% in May, compared to the 5.3% growth observed in May the previous year. Additionally, the growth rate of accounts was only 0.1%, in contrast to 2.8% a year ago. However, the higher interest rates pose potential challenges for young adults, some of whom have turned to credit card debt to counter the effects of inflation eroding their savings. Individuals under the age of 25 with credit card debt have experienced the most significant increase in the past year, with the average credit card balance for this age group rising to $1,376, a 16% increase from the previous year's $1,182. This surge is primarily attributed to the fact that young adults have not yet entered their peak earning years but have been impacted by inflation. Moody's economist Kyle Hillman noted, given that young and lower income borrowers have likely depleted a large share of, if not all excess savings at this point, it is not surprising that these individuals are using unsecured credit to augment their spending. However, increased indebtedness will lead to higher delinquency and default rates as the job market weakens and wage growth slows, a concerning development for lenders active in this space. Currently, the total credit card delinquency rate, which includes late payments, hovers around 3.5%, according to Hillman. While this is below pre-pandemic levels, it remains a full percentage point higher than the rates recorded in May of the previous year. Additionally, experts have voiced concerns about potential trouble in other segments of the credit market, as banks reduce lending following a series of regional bank failures earlier this year. Tighter lending conditions, combined with higher interest rates, could more than double the rate at which companies default on their debt, as estimated by Société Générale earlier this year. And this brings us to the most important question: what happens next? I know there are many Fed members who are downplaying this rising trend, arguing that it has peaked this year and that we could begin to see it go back down, but I am no convinced. This is because, based on data I have come across for nearly a year, every metric available out there shows that there is a growing number of Americans are grappling with car loan and credit card payment delinquencies, marking the highest levels in over a decade. This worrisome trend reflects mounting financial stress among consumers, with rising prices and increased borrowing costs straining household budgets. Lower income earners have been hit hardest, having largely exhausted the savings they accumulated during the pandemic, thanks to government stimulus checks and brakes on obligations like rent and student loans. Remember what Mark Zondi, the chief economist at Moody's Analytics, said about this: that the increase in delinquencies and defaults is symptomatic of the tough decisions that these households are having to make right now, whether to pay their credit card bills, their rent, or buy groceries. You see, as the economy transitions to a post-pandemic phase, signs indicate that the hardship for millions of consumers may worsen before improving. The average credit card interest rate, already at a record high of 20.6%, is expected to continue rising, with the Federal Reserve contemplating further rate hikes to combat inflation. Student loan payments, paused for over 3 years, are set to resume in October. Banks and lenders have been tightening credit access for months, a trend that accelerated following the spring banking crisis. While these difficulties reflect the Fed's efforts to curb inflation, economists believe there is no imminent risk of a recession due to the mounting pile of overdue bills. The economy is perceived to be in fundamentally sound shape, with historically low unemployment rates and a slowdown in price increases. However, financial stress is becoming more pronounced among lower-income individuals. Many lower-income borrowers are resorting to credit cards to make ends meet, resulting in a significant increase in credit card accounts since 2019. Furthermore, shoppers are increasingly turning to buy now, pay later services for essentials like groceries. Retailers have taken notice, reporting rising delinquency rates on private label credit cards, affecting revenue for companies like Macy's, Walmart, Target, Costco, and thousands of mom-and-pop shops. Inflation remains a concern, and essential goods are considerably more expensive than pre-pandemic levels, prompting Americans to trim discretionary spending and turn to off-price and discount retailers. Rising interest rates and the cost of debt have added to consumers' financial strain, leading some to live beyond their means. Delinquencies on auto loan payments, already at crisis-era levels, are expected to continue rising, particularly among subprime borrowers. Car prices have surged in recent years, and consumers now take on more debt to purchase vehicles. This trend is compounded by the fact that low and middle-income individuals are faced with larger monthly payments for the same car. Despite these challenges, economists anticipate that credit card delinquencies will keep rising, particularly in the second half of the year, with higher energy bills and holiday expenses further contributing to consumer debt loads. Auto loan delinquencies are unlikely to peak until next year, and the situation remains very concerning. In summary, a combination of factors, including rising interest rates, the resumption of student loan payments, and elevated costs of living, has put significant financial stress on many Americans, particularly lower-income earners and subprime borrowers. This trend highlights the challenges consumers are facing in maintaining their financial stability in the current economic environment. Guys, thank you so much for watching this video through its end. I know it's a lot to take in, but it's super important to be aware of all the changes happening across the economy, even if it doesn't affect you. Let me know what you guys think in the comments below. I will be working to release another video later this week. Come join my Discord if you want to become a day trader, and if you want to support the channel, consider becoming a member. Thank you and to the moon.